When embarking on your investment journey, the initial question that often looms large is whether to channel your resources into real estate or mutual funds. In this video, we are about to dive deep into the intricacies of these two investment avenues. Our goal is to equip you with the knowledge needed to make an informed choice regarding your investment path. Consistency. When contemplating real estate investment, one pivotal factor demanding your attention is its inherent volatility. It's a common misconception that real estate always steadily appreciates. In reality, real estate investments can be a roller coaster ride, with value sometimes taking unexpected twists and turns. Imagine you acquire a property on the outskirts of a city earmarked for development. Initially, the value might surge as the area flourishes. However, this upward trajectory isn't guaranteed to last. Factors like increased traffic or deteriorating city access can lead to a gradual depreciation in property value. In stark contrast, mutual funds have proven to offer a more consistent track record, consistently outpacing inflation in recent years. While mutual funds do carry an element of risk, this risk can be managed by opting for moderately risky funds like debt funds or hybrids, known for their stability and dependable returns. Before we delve deeper into these investment options, remember that staying informed is the key to smart investing. To keep receiving valuable insights like these, make sure to hit that subscribe button and join our growing community of savvy investors. Now, let's continue exploring the world of real estate and mutual funds. Performance. In the current landscape, the performance of real estate investments lags behind the returns offered by mutual funds. Real estate has somewhat assumed the role of a fixed deposit, yielding returns that are, for the most part, on par with it. Conversely, mutual funds have emerged as a popular choice for those seeking to build wealth while safeguarding their investments from the eroding effects of inflation. The compounding magic of mutual funds can generate more robust returns when contrasted with real estate, which often struggles to shine in the face of inflation. Litigation. The last scenario any investor wishes to encounter is the entanglement of their investments in a protracted legal conflict. Prolonged disputes can be a wearisome ordeal, drawing out over an extended period and draining the investor's patience. What's more, there are instances where investors may find themselves shelling out additional hard-earned funds during such disputes. This not only erodes the property's value but also diminishes the returns yielded by your investments. In contrast, mutual funds enjoy the benefits of robust regulation and oversight courtesy of the Securities Exchange Board of India, SEBI, making the likelihood of litigation or disputes a rather remote prospect. Monitoring. Real estate investments are frequently viewed as precarious, primarily because of the challenge of effectively monitoring their performance. Neglecting to keep a close watch on your real estate investments can potentially lead to disputes, especially if you've entered into a property investment venture with partners. On the contrary, the beauty of mutual funds lies in their ability to be monitored conveniently online. This means you can regularly assess the performance of your funds, significantly reducing the likelihood of disputes or legal entanglements. Returns. In terms of returns, investing in mutual funds stands out with notably higher yields compared to real estate investments. Real estate returns typically fluctuate between 7% and 11% annually, while the realm of mutual funds showcases returns that span from 14% to 19% per annum, contingent upon the specific fund category. This substantial variance enables investors to harness returns that effectively combat the eroding influence of inflation, facilitating the accumulation of wealth. Investment. The size of your initial investment can significantly impact your choice of investment avenue. With real estate, substantial financial resources are typically a prerequisite, and this can pose a significant hurdle for many prospective investors who may not have the necessary funds readily available. In contrast, mutual funds offer the flexibility of entry with relatively modest sums or more substantial lump sum investments, depending on your financial capacity. You can engage in mutual fund investments through a systematic investment plan, SIP, which allows you to allocate a fraction of your bank account funds. These allocations are conveniently and automatically debited every month, enabling you to start investing without the need for a substantial upfront capital commitment. Tax implications. Both real estate and mutual fund investments offer tax advantages, yet mutual funds enjoy a distinct advantage, often hailed as tax-saving instruments by a significant portion of investors. Concerning Section 80C of the Income Tax Act, 1961, individuals may qualify for tax benefits of up to a maximum of 150,000 rupees for investments made in mutual funds. This avenue provides an opportunity to reduce tax liabilities. Real estate investments, too, present tax-saving potential, albeit through indexation. Indexation comes into play by factoring in the influence of inflation on the real estate value of your property, thereby lowering your tax obligations. However, it's worth noting that the tax exemptions available for real estate investments generally pale in comparison to those offered by mutual funds. Liquidity. One of the foremost considerations in any investment strategy is the aspect of liquidity. The ability to swiftly convert investments into cash is highly valued by investors. Real estate, unfortunately, doesn't offer such convenience, as it lacks a readily accessible market for expeditious transactions. The process of liquidating real estate holdings can be protracted and cumbersome, making it less than ideal when you find yourself in a financial bind, needing quick access to funds. In stark contrast, mutual funds provide an appealing solution with their inherent liquidity. Investors can easily sell their fund holdings through online markets whenever the need for liquidity arises. This flexibility to access and utilize your funds promptly is a compelling reason many individuals opt for mutual fund investments. Power of compounding. Mutual fund investments have the remarkable ability to yield substantial returns over time, primarily owing to the phenomenon of compounding. This advantage is not readily available in the realm of real estate. To illustrate, consider an investment of 200,000 rupees in mutual funds, which consistently provide a 14.9% annual return over 20 years. At the end of this tenure, your investment would have grown to a remarkable 32.17 lakh rupees. Opting for mutual funds allows you to harness the potency of compounding and attain returns that effectively outpace the ravages of inflation. Ease of investing. Real estate investments come with an intricate web of procedures and documentation, further compounded by various associated costs like sale charges, stamp duty, and registration fees. These aspects can make the investment process laborious and time-consuming for individuals. Conversely, when you opt for mutual fund investments, the process is remarkably straightforward. Within a matter of minutes, you can initiate your investment journey. All it requires is setting up a systematic investment plan, SIP, enabling automatic monthly debits from your bank account. What's even more enticing is that mutual fund investments do not burden you with additional expenses, making them a hassle-free choice. What are real estate investment trusts, REITs? While the preceding contrast primarily pertained to the conventional modes of real estate investing, it's worth noting that real estate investment trusts, REITs, have entered the scene with increasing popularity. REITs essentially represent an equity asset similar to a fund, with their investments directed toward real estate-related assets, including commercial office buildings, corporate parks, shopping centers, and retail outlets. In essence, a REIT operates much like a mutual fund and offers a convenient avenue for entering the world of real estate investment. It brings with it the benefits of diversification and the potential for long-term capital growth. With REITs, the once daunting demands of substantial capital and intricate paperwork are significantly reduced, making real estate investments more accessible and streamlined. Conclusion. In the realm of investment choices, real estate has historically retained its appeal for a significant portion of investors. Nonetheless, recent years have seen it evolve into a somewhat riskier investment, marked by fluctuating values. Emerging options such as REITs inject a refreshing perspective into this landscape. In contrast, mutual funds stand out for their capacity to deliver robust returns with a controlled level of risk. As an astute investor, the pursuit of a diversified portfolio that maximizes returns remains a priority, and mutual funds prove to be an instrumental tool in achieving this objective. In conclusion, we've delved deep into the intriguing world of investment, comparing the merits of two formidable contenders, real estate and mutual funds. We've explored the nuances, risks, and rewards associated with each, providing you with valuable insights to make informed decisions. But our journey doesn't end here. If you're keen to expand your investment horizons and consider another compelling option, we invite you to explore our video on real estate versus gold investment. Much like the wealth-building strategies we've discussed today, the realm of real estate and gold investments share a unique synergy. So, stay curious, keep exploring, and make your financial future a prosperous one. Thank you for joining us on this enlightening journey.